Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 15th of January. I'm Daniel Lam, your host for the podcast. Earlier this month, the US non-farm payroll was stronger than expected. That led to some questions as to how fast and how much the Fed would be cutting rates this year. Naturally, this also draws investors' attention to the US CPI figure, because a stubborn figure would lead to investors scaling back on the rate cut expectations this year. Overall, the US CPI inflation number at the end of last week was a mixed bag. On the headline level, it came in slightly higher than anticipated. Headline inflation accelerated from 10 bips to 30 bips on a month-over-month basis and rose from 3.1% to 3.4% on a year-over-year basis. Most of this increase came from shelter and used vehicles. Now, the market reaction was actually very muted. Well, if you dig deeper and look at the super core inflation, i.e. core inflation excluding shelter and used vehicles, it actually printed at 18 bips in December and is running at 2.45% on a 12-month basis, so that's actually quite consistent with the Fed's target. And now, the leading indicators for both shelter and used vehicles continue to point towards significant downside for the year. So for example, for shelter, indicators of asking rent growth peaked in early 2022 and remains downbeat. The rent of primary residence and owner's equivalent rent components of CPI peaked in early 2023 and are following asking rents with a lag. Now turning to goods, we see that core goods inflation, excluding used vehicles, is actually running very close to or below pre-pandemic levels. And meanwhile, wholesale auction data shows that used vehicle prices have more downside to come this year. So overall, this set of data justifies what we've been discussing last week, i.e. the markets may have run ahead a little bit too fast over the last 2 months of 2023 in terms of Fed rate cut expectations and the timing of such. So in the very near term, we may see a period of consolidation, which gives opportunities for investors to be adding onto long duration trades, such as US growth stocks and DMIG government bonds. Now, investors may consider adding to these trades if they see the following levels: 104 for the DXY, 4.2% for the US 10-year government bond yield, and 4,600 on the S&P 500 index. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.